Second quarter earnings season kicks off after the bell today. Stephen Wieting is managing director of Citigroup's economic and market analysis team. He joins me now with a look back and a look forward. Mr. Wieting, welcome to Bottom Line. Appreciate it. First quarter earnings came in stronger than anticipated. Can we expect a repeat for second quarter?
Well, if we do, a large reason for it is in the last 2 weeks, analysts have cut aggregate earnings estimates 5.5%. The bar has been lowered for the second quarter period, but probably not low enough for the second half of this year.
Even with Friday's ugly jobs report still lingering in the back of people's minds, is that going to have an effect at all?
Oh, I don't think that had direct effect on estimates. I think it raises questions about the performance of the economy. Clearly, but that's probably a bit unrelated to what companies will tell you about the outlook.
Even though the economy's been sluggish, we've seen that corporate profits did pretty well, even though businesses aren't hiring. How's that possible?
Well, there's been demand in the economy. We're at a new all-time high on consumption expenditures a long time ago, in fact, around the fourth quarter of the year, of last year, if I recall, with about 7 million at this point, 7 million fewer people working. But that demand is there in the economy. I think that fiscal easing, which you talked about a great deal on, line today is borrowing and spending in the economy, and that's real sales. That's 9% of GDP.
Sum up the second quarter for me. Who were the winners and the losers, and perhaps who might be the wild card?
Well, if you look at the second quarter, it's the legacy of the really sharp ramp up in commodity costs through April. So energy and materials will see very substantial 40% type of earnings gains.
Even with the high gas prices and even what's been going on in the Middle East?
Well, that's their earnings. It's someone else's cost, but it is their earnings. The issue is the back half of the year, where if you look at the energy sector, large oil companies, it'll be more difficult to get a 40% earnings gain in the back half of this year after the downward correction in oil prices.
What about valuations? A lot of them still seem to be stuck at pre-crisis levels, no doubt.
Well, I think that there's a fairly low expectation for long-run growth in the United States, and a lot of this, really is, will we have our own fiscal problems that become our own sovereign problem in terms of economic activity going forward? We think that that's part of it. Again, as I mentioned, that extremely easy fiscal policy, and we're not making arguments or judgments about whether we should have that in the short run or not, but that has a big effect on estimates for how we're going to perform in the long run.
Alcoa, the bellwether, it's the first one out of the gate after today's close. Any expectations for Alcoa and some of the other ones?
I can't comment on individual companies on that, and from a macro basis, it would be difficult too. Yes.
Talk to me about growth expectations then for the third quarter. If the numbers come out the way some analysts have been telling us they might, is this going to be a trend that we're going to see going through the end of the year? Sluggish, albeit steady growth?
Well, earnings have so outperformed the economy, as you already mentioned. It's been dramatic. And to a certain extent, it still continues. But earnings grew, we estimate, 35% last year. We're thinking 15% for the full year now. But earnings have been slowing, 35 down to 15. We think that earnings will grow about 12% in the back half of this year. The estimates show even more than that.
If I could ask you in the last 30 seconds, the trend right now, is it one of earnings growing stronger than the real growth rate?
Yes, profits have been moving up as a share of GDP. They've been moving up faster than revenues. They were beaten down very, very sharply during the downturn, so they have that snapback quality to it. But we think that that is now in a transition where companies are going to be able to earn their revenue growth rate, but not sharply more than that, particularly next year.
Stephen Wieting, he's managing director of Citigroup's economic and market analysis team, joining us on set. Pleasure to have you on today, sir. Thanks so much.